Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Hello, and welcome to our series on evaluating and calculating borrowers' income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. This is part 6 of our series, and today we'll discuss income conundrums. Just as in life, there will always be unusual circumstances that will leave us perplexed on how to proceed when it comes to income calculation. Today, we'll look at some income conundrums, such as a borrower who is between jobs but has accepted new employment, or a borrower who is compensated via a 1099, or perhaps you discover that your borrower is on leave, or maybe there is income that may be ineligible. These type of situations can be challenging, but this video should help prepare you for handling these unusual circumstances. So, let's get started. Call it bad timing, but your borrower has applied for mortgage financing and is currently between jobs. The good news is that they do have a job offer in hand. However, the challenge here is that they may or may not have started their employment by the time of loan delivery. First, we'll document the file with an executed copy of the non-contingent employment offer or contract that clearly identifies the terms of employment, including position, type, and rate of pay, and start date. By reviewing the start date, we will know which path we will follow. So let's look at two options. One where the borrower will start the new job before loan delivery, and the second where they will not. Option number 1, the loan will be delivered after the borrower starts their new employment. In this case, we would document the file with a pay stub that includes sufficient information to support the income. This documentation should be included in the file at time of delivery. Option number 2, the loan will be delivered before the borrower starts their new employment. In this case, the employment must start within 90 days of the note date, and additional reserve requirements may apply. It should be noted that option number 2 is only available for the purchase of a one-unit primary residence. The borrower cannot be employed by family member or interested party to the transaction, and only fixed income may be used to qualify. The borrower whose income is reported on a 1099 presents a challenge. They may not have any percentage of interest in the business for which they work, so technically they're not considered to be self-employed. However, they are not considered to be an employee either. So how do we deal with these type of borrowers? The challenge is that the documentation required is undetermined until you know how they are reporting their income. Is it reported as other income on the Schedule 1 of the 1040s? In which case you'll be able, in most instances, to calculate the income from the 1099s using variable income rules. If, however, the borrower reports this income on Schedule C, then in most instances you will need to follow the path that you would for a self-employed borrower and cash flow this income. Some examples of occupations that may receive a 1099 are independent contractors, freelance workers, clergy, truckers, and traveling nurses. Let's take a closer look at some of these type of workers, starting with traveling nurses. When your borrower lets you know that they are a traveling nurse, there are some questions that need to be asked. Are they employed under a staffing contract and paid via a W-2? Are they an independent contractor with one or more contracts paid via a 1099? If an employment contract is provided, it may also be reviewed for the purposes of determining stable monthly income. So if your borrower is an independent contractor, Take into consideration whether or not the borrower has demonstrated the ability to maintain steady and continuous employment and income over the past 2 years. There should be a minimum of a 2-year history of employment as a nurse, as well as a 1-year reported earnings history as a traveling nurse. If they report their earnings as other on Schedule 1 of the 1040s, then you will calculate their income using the 1099 earning trends. Or if they are filing their income on a Schedule C and itemizing their expenses, then you will generally use the self-employed guidance and cash flow their income. Perhaps your borrower is a member of the clergy. The challenge here is that clergy are paid in many different ways. They can receive a W-2, 1099s, or they may even be considered self-employed. Compensation can be structured in many ways and include salary, housing allowance, and auto allowance. Document with a letter from the church along with the most recent 30-day pay stub and W-2s or verification of employment. Tax returns may also be required. Verify a 24-month history of employment. Income will be calculated based on the compensation structure. If a W-2 employee, it will be based on the salary. If 1099, use the variable income rules. If self-employed, income should be cash flowed via review of Schedule C. Non-taxable income, such as housing, can be grossed up if there is at least a 12-month history of receipt. Truck drivers can be compensated in a variety of ways. They can be paid by the hour, which is typical of drivers who transport goods less than 150 miles from their base of operations, such as UPS, FedEx, retail, and grocery chains. This type of pay structure can be fairly straightforward. However, a large portion of the trucking industry is paid by the mile rather than by the hour. Drivers may be paid a percentage of the load. These drivers are usually owner-operators. Drivers may also be paid stop pay, which is compensation for waiting while the loading and unloading occurs. Drivers can also be paid for additional services performed beyond hauling a load. Determine how your borrower's income is reported. Do they receive a W-2, 1099, or is their income solely reported on their federal tax returns on Schedule C? Document and calculate their income accordingly. Per diem pay is generally not going to be eligible income for mortgage qualification because it's meant to compensate drivers for actual expenses. Keep in mind that the IRS does allow transportation workers to claim up to 80% of their meals, and therefore only 20% of meals would need to be deducted while cash flowing income. Another difficult situation is when a borrower is on leave. Your borrower may be out on leave at time of loan application. If the employer indicates that the borrower is on temporary leave, then the borrower can be considered to be employed. The lender must document the duration and amount of temporary leave income, if any, and then the amount of regular employment income received prior to the leave must also be documented. Both the employer and the borrower must confirm the date of expected return. How the borrower's income will be calculated depends on the date of return. Option number 1, use the borrower's regular income if they are scheduled to return to work on or before the first mortgage payment due date. Option number 2, use the borrower's temporary leave income to qualify the borrower if they are scheduled to return to work after the first mortgage payment is due. If temporary leave income is lower than the regular income, then liquid assets in reserve may be used to supplement the income. How do we do that? Most lenders will have a simple worksheet on how to calculate temporary leave income. An example is shown here. Now let's look at a specific example. Our borrower is receiving a monthly temporary leave income in the amount of $3,000. They have liquid assets of $38,000. Closing costs are $15,000, and the required reserves are $3,000. The $18,000 required for closing and reserves is deducted from the liquid assets, which leaves us with $20,000. The total months on leave has been verified to be 4 months, which then represents $5,000 of liquid assets per month. $5,000 is then added to the leave income of $3,000 to equal $8,000 per month. We had verified the borrower's regular compensation to be $7,500 per month. The lower of the temporary leave or regular leave income will be used. So in this case, we would use $7,500 per month for the qualifying income. And then there are those difficult times when a borrower's income can't be used to qualify for a loan. Some examples that may be ineligible includes per diem income, rental income from a second home, trailing co-borrower income, VA educational benefits, retained earnings, gambling earnings, unless your borrower is a professional gambler, draw income, unemployment not associated with seasonal income, and mileage reimbursement. Questions to ask. Do I have a clear understanding of the nature of the borrower's employment and pay structure? Do the borrowers have an acceptable work history that would support their ability to maintain similar earnings in the future? Take a moment to check your understanding. Do you know if these statements are true or false? Let's go over them together. A borrower who has a job offer must start employment within 90 days of note date. This statement is true. A borrower whose income is reflected on a 1099 is always considered to be self-employed. This statement is false. Per diem income is generally not eligible for use as qualifying income. This statement is true. A borrower who is on leave must return back to work prior to closing. This statement is false. Rental income from a second home is eligible as qualifying income. This statement is false. Remember, qualifying income must be reasonable, verifiable, consistent, stable, and likely to continue.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.